Hey guys, welcome to this week's money news in human words. And look, it's been a big week this week. There's been a ton of stuff going on, not the least of which around this inflation crisis and the Reserve Bank meeting, which is going to happen later this afternoon. Uh, the one bit of news that's probably not fully money related, but an interesting one that sort of flows through to money is the fact that it's looking like from the data that's coming through that this wave of COVID is going down. So this is not necessarily a money thing, but it indirectly affects our money because there's a lot of talk for the potential for the current wave of COVID to have a negative effect on the economy now that it doesn't look like this is happening. So, game on when it comes to investing and all of the things that sit around that. So the first big piece, and I think inflation is the word of the day here, but the forecasts around this has inflation potentially turning negative next year, which seems like a pretty drastic turnaround from where we're at the moment, with it currently coming in 6%. It's like a multi-decade high. And off the back of that, they're talking about interest rate relief coming sooner than predicted. So potentially rates coming down as early as next year. So basically, this is well ahead of what was previously predicted in these forecasts. And I suppose that in itself highlights the fact that, how variable these forecasts can be. And particularly that, we see that there's always talk that these things get overblown and people are saying, oh, the rates are going to, rise these drastic levels and it's going to be there forever and the economy is going to go into recession. There's going to be a property market meltdown. But then those things change. And one thing that I've noticed is that in the COVID crisis, we saw that, like particularly at the start of a crisis, that you see that the forecasts tend to be really aggressive and really pessimistic. Then on the recovery side, when that recovery happens, that they potentially talk about it being fairly optimistic in the short term as well. But these things tend to change, and I think it's just about sticking to those medium to longer term fundamentals. But while rates are tipped to drop from next year, today it's pretty likely that rates are going to rise by 0.5%, which brings the rate rises to 1.75% in just the last 4 months, which is the fastest acceleration of interest rates in Australia in about 3 decades. What that means, like for mortgage payments for fixed rate borrowers, they're set to increase by 40% over the next 12 months. And for variable rate owners, they're already feeling a pinch of these higher interest rates, which the cuts have been passed on pretty swiftly by the banks. So, consequence, we've seen a dramatic a slowdown in household savings. So, looking at the recent data over the last 2 months, households in Australia saved a combined total of $5 billion, which seems like a really big number. But when you compare it to the previous months, the household saved $25 billion in the 2 months prior. So a massive gap, and essentially saving, 20% of what was saved in just the recent past. Could be a little bit of seasonal stuff in there. So it's not necessarily a full-blown trend. It'd be an interesting data point to keep an eye on over the next little bit. But pretty significant. And I think what that should mean is, I suppose, it's sort of a headwind for inflation, which is a good thing when we think about interest rates and then economic growth. So that inflation is coming down faster than expected, and partly as a result of some of the external pressures that we've seen on inflation over the last little bit, particularly the cost of oil, freight and manufacturing costs off the back of the Russia war driving up energy prices. And these external factors are now naturally easing on their own, which again takes some of the need away from the RBA to continue raising interest rates. If we see those things coming down on their own, then like I say, the RBA doesn't have to raise rates as much to pull back on inflation. So in the markets, or the market response to the data that's coming in now, we're seeing bond traders are reducing the outlook for long-term interest rates. So bonds are, pretty good proxy for longer-term interest rates. We're seeing that outlook coming down. And look, I think again, just touching back on what I mentioned at the start, that it reinforces that things change quite quickly. Things are always supposed to be worse. That tends to feed into the clicks and the eyeballs on stuff and fear for people. But then things don't play out like that. So given that the recovery is now seeming like it's going to be like happen more quickly, and the downturn period is going to be shorter than previously anticipated. That means that if you want to take advantage of the current downturn to build wealth, then now is the time to move. And I think one of the things that I've been really enjoyed seeing over this current crisis, and it's never obviously good to see downturns in markets, property market, share market, etc. But I feel like people are coming to the realization that while it is bad, obviously, when there's a share market downturn or a property market downturn, that is the opportunity to actually get ahead. When things come off, you pick up a good quality investment asset, property, share, index fund, or whatever, knowing that this will be a temporary thing and these are medium to long-term investments, and you're going to benefit from that. So I think you don't want to be sitting on the sidelines for too long and missing the opportunity to actually come out of the other side of this period of disruption in a stronger position than you went in. And I think the other thing for mortgage holders in particular, steel yourself, because regardless of the fact that there is things recovering quickly, there is going to be some short-term pain, and it's going to be a fair bit of pain with the such large jumps in interest rates over the last little bit. That piece also flows through to what's going on in the property market at the moment. And over the last week, I've been looking at the fact that property vendors are facing some of the tougher selling conditions that they've seen in years. Looking at the data around the amount of stock that's coming onto the market, we're seeing more come in, but the current stock isn't clearing, which means that property buyers are spoiled for choice at the moment. There was some data released by SQM Research that showed that in June, property listings that had been on the market for longer than 6 months rose by 1.6%, which is quite a substantial jump. But so that's meaning that these properties are staying on the market for longer, that there's more properties in the market that have been on there for a long time. And new listings did fall, but they're still positive. There's still more and more properties coming on, and the older ones are staying there for longer. So their director, Louis Christopher, who's a really great guy. I've had the pleasure of chatting with him about his take on money, and he's pretty switched on when it comes to property. He's been in it for like 40 years or something ridiculous like that. He says that spring will be the weakest point in the property market. So essentially over the next 3 months. What that means, though, that what you should be reading in that is that for buyers, that this is going to be the very best time to buy. It will be over before you know it. So if property's on the roadmap for you, it means that get your ducks lined up and get ready to rock so that you can take advantage of those conditions. For vendors, this piece I was reading is saying that it's like it makes sense for them to come into the market now because prices are likely to soften a little bit more. What that means is that if a property vendor can sell their property quickly, they can get a better price. Now, they know that, and now you know that, which means that if you're looking to buy a property, know that the person that you're buying the property off is going to be highly motivated to sell that property quickly. That means that they're going to be more interested in engaging in a conversation with you. They're going to be more willing to negotiate. They're going to be comfortable to shave a bit off the price and get that property sold now, giving themselves a peace of mind that they're not going to be in the market in 3 months' time where conditions could be softer. So that could massively works in your favor. I think if you're a property seller or a potential property seller, if you don't have to sell your property, now is probably not the time to do that. Think about using instead the equity, if it works for you, and it's important to manage risk around this, but using your equity to invest, maybe pick up another property or your next property, then ride out the period of down. And when the market recovers, you can sell the property that you're thinking about selling now, but having benefited from that upside on two properties, you'd be in a much stronger position. So As a financial advice company, we help people buy shares, we help people buy property, but we know that property wins because it's not like you get $1 million from your bank account and go buy $1 million property. You go get a small chunk of money, a deposit, and go borrow a bunch of money from the bank. And then you've got this accelerated return. So if you can buy in softer conditions now, see that through to that recovery, it means you're going to be in a much stronger position. The next thing that I wanted to cover, again, staying on the property theme, is talking about this risky tactic that we're seeing more and more of in the market at the moment, with property buyers looking to pick up a big bargain. They're talking about the fact that, given the soft property market conditions that I was just talking about, there's a bunch of would-be property buyers that are lowballing property vendors to get the price down to pick up a massive discount. And in this article I was reading, they were talking to a heap of real estate agents who were talking about the fact that vendors aren't desperate, or the majority of vendors at least, they're not desperate. So they're getting offended by these ultra low ball offers and walking away from the buyers when the offers are just massively low and not based in any reality. So for anyone that's looking to buy a property, as I was just talking about, it makes sense to be taking advantage. But there's a good lesson here that if you want to get your bargain, you have to be engaging with a vendor, and you want to be around the money. You want to get a discount to the value, but you want to be somewhere close to the value, because if you go in offering something that's ridiculous, then you're likely going to piss off the property seller, and they're not going to want to engage with you. So a way that you can get around this, a bit of a pro tip, is that if you want to come in to negotiate on a property, find some comparable sales data. A lot of that is publicly available these days and can be accessed through an advisor, a mortgage broker, buyer's agent, potentially a bank, or maybe online if you're prepared to do a bit of digging yourself. You find the comparable data to back it up and say, okay, this is what's selling around, and this is why we think that the property that you're selling is only worth this. Now, that takes a little bit more work, but the vendor is going to tell that you're serious, and it's going to give you a much better chance of getting the result and outcome that you want when you buy a property. It'll also give you a good sense of the market if you do that for a few properties, because you're going to see that comparable sales data to know how much you could or should be paying, to see what's going on, especially as the market conditions are moving around over the next little bit. But look, I think whether you do that or take a different approach, regardless of your tactics, you want to make sure, if you do want to buy property, make sure you let the vendor know that you're serious and try and start a conversation that draws them in. And as I was talking about in that previous piece, that because vendors are going to want to be selling in the shorter term, that you're going to be much more likely to get a better outcome. Changing tack a little bit and talking about oil prices. So I have seen the cost of the Bowser has come down over the last little while, which is welcome news as someone that's got a substantial commute into our office and been paying through the nose for petrol over the last little bit. Massively welcome. But when you scratch the surface on what's going on there, you can see that the actual, like the wholesale prices has come down much more than the prices have come down at the Bowser. So essentially the market price for petrol out of Singapore has come down 44 cents a litre from its highs, and the wholesale price is down 40 cents a litre. But at the Bowser, we've only seen an average drop in petrol prices of 19 cents. Looking at it from an investment market perspective, Beta Shares has got an interesting investment that tracks the oil price. This is not advice or a recommendation, but it tracks the oil price. It's down 23% in July. And so we see the market has moved there, but because the petrol companies are not passing on these discounts, everyone's blowing up, particularly the government. We've seen Treasurer Jim Chalmers come out and give the petrol companies a blast and put them on notice, highlighted the fact that a lot of the cost in petrol, those cost increases have been passed on pretty much immediately, but the drops are coming slowly, and they're not coming down all the way to what the rises were. Petrol prices for motorists, so the monthly petrol spend for motorists is now $270, up $48 from just the start of this year. And petrol prices have been a major contributor in the inflation rises. So we want to see those discounts getting passed, or not discounts, but the reduction in the prices getting passed on, so that inflation starts pulling back and we have to see interest rates rise less. But overall, the fact that oil coming down is a really, really good thing for the economic conditions. And a lot of times that tends to happen based on the economic outlook. So now that they're forecasting a recession, we're seeing what was the technical definition of recession being met in the US just recently, so that the people are expecting less, oil prices less supported. So let's just cross our fingers that those reductions in price make its way through to motorists. Bit of a interesting one from ANU over the last week. So the Australian National University, who put out this big research paper pitching a land tax to repay the massive government debt that we're seeing. And it seems likely that younger people are going to be the ones carrying most of the cost of repaying the biggest government debt that we've seen since World War II. Currently at 40% of the total gross domestic product, or the total size of our economy. Essentially, the ANU have just come out with talking about how we can repay it, and pitch the best idea being a land tax, where they would tax the value of unimproved land, and that would raise like $8 billion a year. They also looked at other things like income tax and raising income tax rates, but noted that that unfairly affects younger people who are still like at peak earning years, but still trying to build their assets. They also looked at raising the GST as well, which was not as favorable than the property tax, which they're saying that is older people protected most with a lot of the COVID spending. They were the most at risk from a medical and health perspective. And they've got the most assets, so it makes sense to tax on assets. Then the older people pay more of the tax. But for mine, I think the older population carry a lot of voting power, so it's sort of hard to see where this will get through. Labor have come out saying that there will be no new taxes in the current year, but they are going to need to do something with debt levels as high as they are. So time will tell as to what happens there. Talking investment markets, and this time of year, we're seeing fund managers having to write to investors to explain their performance. Now, for the last couple of years, that's been a pretty easy task, with markets kicking off and a lot of them making pretty massive returns. But this year, it's pretty challenging. So there was a big study done by the Bank of America on 2,000 funds that were managing a combined amount of $17 trillion. So a pretty massive amount, finding the top 10 reasons that funds underperform. And I think there's some pretty interesting lessons in there. The first one is incorrect assumptions about alpha generation. So alpha is essentially the return premium on an investment above the return on the market. So they're incorrectly assuming, how and why that extra upside return is generated. The second one is assumptions around how the markets will react to certain events. And obviously there's been a lot of different events globally over the next little bit. Third is static allocation. So looking at not changing investment allocations over time. Next is focusing on the bottom up alone. So focusing on the performance of a particular company and ignoring the top down factors. So the economies and markets as well. Obviously, it doesn't matter how good a company is at the moment. A lot of businesses are facing tougher conditions. So if you're just looking at the company itself, it's not necessarily going to perform better if the economy is massively struggling. Next piece was risk aversion in an upturn. And I see this from fund managers as well as individuals, that people don't want to take on risk when markets are coming up, because there's still that fear around that. For fund managers, they don't want their funds to be going backwards. So they take less risk and they don't benefit from the upside as a result. The next is unintended exposure. So investing in one company and getting exposure to another, or another sectors or markets. An interesting one on extrapolating investment lessons from the US market. So thinking that what happens in the US will happen across the world. Big cause of markets declining. Basis risk, which is essentially like a strategy around hedge funds and derivatives, where they're offsetting investments, but where the thinking that the strategy will not experiencing price changes in completely opposite direction. So this is if the investment manager is using options and put options and call options and those sorts of things that they don't expect the markets to move completely opposite to each other. Obviously, a fairly complex one there, but it is a factor, particularly with those more like sexy type funds. Holding cash is another interesting one. That's number 9 on the list, and the final one is transaction costs. So that happens for the big boys and girls that are managing the, as I say, $17 trillion. But a lot of those lessons can come through to individual investor levels as well. And looking at these funds, a lot of them are trying to perform better than the market. In my view, and for anyone that's been following our content for a bit, you'll know that I'm a big believer in passive investments where we're seeing, they are just the market week in and week out. So we know what they are, we know what they do. They're not going to overperform, they're not going to underperform either. So you can avoid all of that risk. Make sure that you've got your strategy set and sleep like a baby, knowing that your money is going to be doing what the markets are doing as well. A bit of light news to finish up on for this week. Jeff Bezos's $500 million super yacht is stuck in a Dutch canal. And there's been a bit of uproar from locals. Essentially, for anyone, I've been following this story for a little bit, which is, it sort of blows my mind a little bit. But one of the world's richest men, he's dropped $500 million US dollars, so about 700 million Australian dollars, to build one of the biggest super yachts ever made, built by Dutch boat builders in a canal over in the Netherlands. And it's so big that they can't get it out of the canal without dismantling this bridge that's been around for like since wartime, essentially in the Netherlands. Now, when he started down this path, there was some sort of loose agreement with the local council that he would be able to dismantle the bridge. He was going to cover the cost of doing that. But there's since been a massive backlash, and the locals are blowing up. They're Dutch people overall, from what I read, and I've not been to the Netherlands or had a ton of exposure, but I was reading that there's a bit of a backlash there against rich people or immodest people more broadly. They say that there's a lot of wealthy people in the Netherlands, but they're pretty modest with how they manage their wealth, and apparently building a $500 million yacht is not that modest. So they're sort of rallying, and now the council have said that they're not going to allow him to dismantle the bridge, which is a tricky one because the yacht is too big to get out, and it can't be the assembly. It's sort of partly assembled, and it can't be finished anywhere else, or so they say. But Bezos, I think, is going to have to use a lot of his creative genius there to figure out where to, because no doubt if you drop $500 million on a yacht, you're probably going to want to cruise that bad boy around. But potentially it might just end up going up and down the canal over in the Netherlands. So guys, I'll leave it there for this week. Hope you've enjoyed that, and I'll catch you on the next one.